Welcome you all to Trading Technicals, our favorite learning channel. Today we will get into option Greeks again, because I think the last video which I had uploaded, which was on a basic understanding of what is option trading and what these Greeks are basically. It was just about it was just an explanation about what is it that alpha, beta, gamma, theta, all these things which are considered. But today I'll try to explain you in a detail as in how this impacts your daily trading on the options. Now most of us we trade in the options on an intraday basis, or maybe some of us trade in a positional kind of trade. Now we need to understand where exactly your option price gets impacted. So now we select our strike price, whichever strike price is, say whatever Nifty is running at 10,800. Somebody prefers to get into a 10,900 call, somebody would try to go for 10,700 put, or somebody wants to go for completely out of money, which is 10,500 put, or maybe 11,000 call. So it all depends on our requirement, what budget we have, or how much money we have, or what is the kind of movement we are looking at. So we need to understand what exactly impacts your stock prices and the option prices. The first important thing is your cash price of that particular stock or index. That is one important factor. Second one is the strike price, which I told you just now. If you are selecting the strike price which is near to your in the money kind of option, that also will move much faster as compared to your out of the money call option or a put option. The third one would be your dividend rate. Let's keep that dividend rate as a common, which will not have much of a thing. The important other part is expiration, time to expiration. Now this is another important part which we need to consider when we are actually trading in options. Then we have what is the rate and the volatility, basically the implied volatility. Now there are 6 things which I told you just now. In that we have only 3 which is very critical from an option trading point of view. So one is the cash price, which is your stock price. Second is your time to expiration. Third one is your implied volatility. Now these are the 3 very critical things which we need to always remember when we trade in option. Now let's just understand which are these 4 factors which we need to always see when we get into an option trading: delta, gamma, vega, and theta. Okay. Now delta, this is already I have explained in my first video. Delta measures the rate of change. Now I will get into a detail of each and every part, like a delta, what is delta, how it's calculated, how we can work on this. And gamma is basically rate of change in delta itself. So what is that acceleration which is happening in delta? Vega, rate of change for the premium based in the change of volatility. And measure the theta, basically our time to expiration. So these are the 4 important things which we always see, and this data is available in some of our brokers. However, most of us, we don't understand this data, and hence we avoid this data. But let's just understand what is delta. Now this is what I had told you last time. Okay, this is what I had explained to you. However, I just want to show you how it works on your real-time scenario. Now this is my this is a NSE website. Again, we are getting into the option chain analysis. Now we have lots of these. You have gone through this particular thing last time video, and you have the strike price here, and then you have the implied volatility, the change on OI, and all those things. Now currently market is at 10,791, and the at the money contract will be 10,800. In the money contract will be 10,750 for the call side, and the put side will be 10,800 is in the money and 10,750 will be at the money. Now and we have implied volatility here. Now just tell me one simple thing. Now if you're moving towards this 10,791 and you have say 8 points to that 10,800 mark, will you be able to understand how much your option premium will run? Currently it is at a 70 rupees, 70.70, and what would happen if this option the index runs to say 10,800, which is 8 points from now? Will you be able to tell me the exact price, what exactly it is? If I go with the current knowledge what we have, I don't think so anybody would be able to answer this particular thing. And this is where our important factor delta comes into picture. Now what is my delta? Okay, so let's go through this upstocks terminal, and let's understand 10,800. Now 10,800. Okay, so I have added 10,800 call here. Let's understand what is it. So we have got all the figures here, which is delta, gamma, theta, Vega, and RHO, and the implied volatility as well. Now let's understand. Now you have got a delta here. Okay, I had just given you the explanation or a definition about what is delta. The option delta is a change of price of the option with respect to the underlying security. So basically what happens now, your delta, you have got it here, which is 0.51. okay, so in this scenario, any movement of 1 rupee in this on the Nifty, this option of 10,800 CE will move by 51 paisa. Okay, I hope you're understanding. So basically, what is a movement which will happen in case if your stock is moving or the index is moving by that particular amount? So here we are saying if the Nifty is running by 8 points more, okay, that is 10,800 it will reach, and our delta is 51. So basically what is going to happen is, if you are reaching 10,800, this option which is currently traded at 70.70, which will be at 74.70. I hope you're understanding, because my delta is 0.51. okay, and when my stock runs by, or the index runs by 1 rupee, it is gonna run by 50 paisa. So basically in that 8 points, I'm gonna get 4 points on my this call 10,800. okay, now this is just a simple example of delta, and it's actually very interesting when we start analyzing options data. And lots of these people, lots of the big traders or the professional traders who uses this data for their own advantage, and they make huge money out of this. Okay, so these are the few things which we'll have to kind of learn when we start trading on options, and when we start learning about options. Now let's understand what all important points again we have to keep in mind when we are analyzing delta. Now delta is always positive for calls and negative for the puts. Why? Because calls, when the market is going up, both the things are positive. Your premium is also going high and your stock price is also going high. It is negative because your value of that particular stock or the index is going down, because that is a negative, and just the basics of numerator and denominator. When there is a negative value, it is going back to the puts. So it is negative for the puts. So always remember, when you see puts, don't get confused that it's a negative delta. What is going to happen? Nothing. It's the same thing. Only thing is, when you're looking at calls, it should be positive. When it is for the puts, it should be negative. Change in premium and change in price of underlying. So basically, it's just a definition again repeated here, so you can ignore it. Delta varies approximate 0 to approx 1. Okay, this is a standard thing which is always there. So it is, if it is deep OTM, which is out of the money contract, you will have delta which is almost equal to 0, because it is not going to move much when the stock price is moving by 1 or 2 rupees or 10 rupees also. And so deep ITM, basically in the money calls, when you are getting into the in the money call, your delta will be approximately 1. Next one is delta varies from 0 to 1 for calls and 0 to -1 for the puts, which again repetition of the first point which I mentioned. So 0 to 1 is for calls and 0 to -1 is for the puts. Always puts will be negative. And delta of stock in future is always considered as 1. So the stock price and the cash, basically the cash price and the future price always runs 1:1. There would be minor changes here and there. However, the changes you will always see as 1:1. So 1 rupee stock goes up, the future will also go up by 1 rupee. Now let's understand what is gamma. Now it's basically again correlating with our delta, because gamma is nothing but it is measuring the change of delta, okay, the rate of change. So basically this is again going back to your delta figure and what changes are happening. So basically what we discussed in delta is basically change in your stock price or the cash price versus what is the change in your option premium. Okay, so here we are checking the change in your delta. What is your change in delta in the premium versus your premium? Okay, so now we'll again go back to our our analysis or the data. Now here it says the gamma is 20, okay, which is which is 0.0020. okay, so let's understand this little further. So now let's just understand, if at all we see a change in our the index, which is by 10 rupees, and so the delta is at 51 and the gamma is at 20. So what we can say is 0.0020. So basically what we can say, when the change in our index, if it is 10 rupees, okay, this delta will take our premium to 51, but the change in the delta itself will be 0.002, which is basically there will be a change of 2 paisa in case if there is a change of 10 rupees in our index prices. So this is what the gamma basically calculates, and it is important to understand because see, this is not a live data, so you're not able to understand the changes. But if you see this data in a live market, you will understand where the premium is actually getting increased and where the acceleration is actually happening, which can also help you to understand which side the market is going to go and what exactly the market sentiments are. So basically what we are trying to say, By acceleration, what is gamma? Gamma is basically the change in your delta itself, and change means the rate of change. Okay, for example, markets are moving up, and the call premium will also move as well. Okay, so the delta captures a change in premium with respect to the cash price, and we created delta, we created gamma basically, which could capture change in premium, not just the whole premium. Okay, so basically what is happening in our scenario. So the option the options, when we are trading, we understand first delta, which is an important part, and to understand or to forecast the delta, we get into gamma to understand what is the kind of change which is happening in delta itself. Now let's understand theta. Now theta, when we initially looked at the theta as a word, when we know it's a basically time decay, and this is another important part for our option trading point of view. And theta is actually a friend of option seller and enemy of option buyer, as you all know. So the time decay plays a very important role in option trading, because whenever you're buying an option, you have to always understand that your the time decay will always lose your premium. So when we actually look at it from this point of view, is every change, so basically whatever the theta calculation is basically done on a basis of the change in premium divided by the date, the expiration date. So basically time remaining to the expiration of date. So what is happening is basically when you're calculating, say let's understand from here, so theta for the nifty call. Okay, now you buy a nifty call and you hold it, okay, expecting the market to go up to 10,700 to 10,800. Okay, so what is happening, so every day when you trade on this particular thing, say you had bought this particular option on Friday, and when so Friday the market did not move, and you expect that this will change on same Monday. Okay, so what will happen? Saturday, Sunday the markets are closed, however it will still consider that as a day, okay, when the calculation happens. So next 2 days there is a premium decay which is going to happen for this particular option. Okay, so theta is basically calculating 10 points, basically the 10 points which will go down on this particular thing per day. Okay, so that is a calculation which is happening. So that is a premium which will be lost out for the days. So, and as I told earlier, and many of you would know, that the option trading, when basically the option selling which happens, this is happening on this. So wherever you see the theta is highest, that is where people generally sell the options. Okay, so you get the maximum premium from selling that particular option. So that is a whole funda of using these skills or these numbers for our daily trading activities. And the time decay will always be there for both calls and puts. So there is no change in calls and puts, that your theta will be always there. Okay, but it's always, remember that it always works against the option buyer and works in the favor of option seller. Theta will be always highest at in the money. Okay, so why this changes happens, because as soon as you move out of this premiums, because we need to always understand when the market is coming to an end of expiry or near to the expiry, Okay, market generally knows where it is gonna go and end that particular thing. So your at the money contract will always have that particular thing, saying that the your theta will always be running at a much higher rate. Okay, so your erosion will be much higher in that particular thing. So when you're coming next to the expiry or near to the expiry, just this week we are sitting here and talking about this data. You'll realize the option premiums are actually eroding much faster as compared to what it started with. Okay, so that is where it is important that in the expiry days we should always close the things in a day or maybe few hours sessions. So option we can always trade. My suggestion is always option you trade in a kind of few hours basis, not even in a day. So you get the maximum benefit out of it, either it's a profit or loss, because even if you're keeping some options with you, say starting of the month, if you're taken an option of say 10,800 and then maybe the value was something else at that particular time, and end of the month market is sitting at 10,800, but you would have lost all your premium, because if we just do an analysis here, maybe say one day. So the option premium for this particular uh, strike 10,800 started at somewhere around 697. Okay, and today it is at 70.70. So you'll understand the market is still near 10,800. There is nothing wrong with it. Okay, probably the market has fallen and it has come down to a level, but still if you look at it, the premium erosion is way too high. Okay, so it's always better we close the options maybe max to max 2 days is what my suggestion is always, because our theta plays an important role. And for option sellers, you have to look at this particular figure, which is very important. Okay, and if you trade on basis of this, you'll always gain huge money. Now let's understand Vega, how the Vega works. Vega is basically considers the the volatility. Okay, so option Vega is basically a measure of impact of changes in underlying volatility on the option price. Specifically, the Vega of an option expresses the change in price of the option for every 1% change in underlying volatility. So basically what is happening, if you remember some other video I had mentioned, when you should not trade an option, or when is the right time to sell the option. Okay, so when the volatility, the VIX, which we always consider for a volatility index, when we see the VIX and we understand the volatility is very high, you would have observed one thing, that your premiums are always higher on that particular day. Why? Because this particular thing is also considered in your option premiums. So when the volatility is high, you'll always get your premiums going up, and that is because of the Vega. Thus, whenever the volatility goes up, the price of the option goes up, and when the volatility drops, the price of option also will fall. So if you really observe the VIX, okay, and when the VIX is actually start cooling down, you would see your options, even though your price of your stock is actually going up, your option is not moving as per that particular movement, which is last few days we have seen that particular thing. When your option premium is not moving, however your the index or the stock is moving much higher. Now let's understand one thing, that Vega peaks at ATM, and it's very important to know this particular fact, because the time value, when we discussed about theta, we have discussed about the time value on the volatility, and when the so when calculating the gamma, also the sorry guys. So when we calculate the Vega, also it is important to know, how it works on the volatility and time to expire. So it will always. So I was just going through some of this data. If you see Nifty 10,800 CE, which is showing Vega at 4.5. Okay, and let's just understand from here. Say 10,000 or 11,000 we will take. Nifty 11,000. Now see the Vega here. The Vega is 2.27 here versus what we had here of 4.5. So basically what is happening is Vega is getting impacted at the time of, so basically it is Vega is also impacting your premium at the time when when it is an ATM contract. The next one is a strike having the higher time value have higher Vega. So basically if you're taking a March month contract which is 10,800 or 11,000, so your Vega will be higher there in that case. And it basically captures the risk part of it. So basically the volatility, the higher risk, higher the volatility, volatility, higher the risk. And basically when your Vega it decreases when we move from ATM to ITM or OTM, and at volatility gets higher, both swings downside and so does the Vega. Okay, so you have to see this particular data in your live market to understand this particular thing in a much detailed way. You need to kind of keep observing these the four parameters, which is delta, gamma, theta and Vega. Now we understood from delta how it impacts. It's basically whatever impact on the cash price, it straight away moves, and whatever is the amount which gets changed. The gamma basically checks what is the movement which is happening in delta itself. Theta, it's basically your time decay. So we need to understand what is it, the time decay which is happening on these options what we are buying or selling for that matter. And the Vega is basically the volatility. It measures the volatility and the impact of that volatility on your premium. So these are the four important parts. Now there is another part which I need to take you through is implied volatility. Now this part I will take you into a next video. Okay, so there are next two videos which I've been working on is basically on implied volatility, because that is part of our option trading basics, and one more is on the different kinds of indicators, which I will try to upload it as soon as possible, but just bear with me till that particular time. You can always comment what kind of videos you would like to see from me, so that I can work on those and I can upload those videos in a short period of time. There is always a challenge with the time right now, because there are multiple activities which I'm going through, lots of backtesting which I'm working on, and there are lots of strategies which I've been working on. So this is the right time, because the volatility is high and there are lots of these movements which you are able to observe. So it's a good time to learn for all of us, and probably we can invest that much of time. Whatever I'm able to learn and I'm able to grasp, I'm able to kind of upload it here. So it would be always great if you guys can comment on it and ask me what exactly you want to see, so that I can upload the things as per your requirement. Also, I would learn with you guys on our trading technical Telegram channel. And thank you very much, guys. Don't forget to subscribe our channel and hit that like button if you like this video. Also, you can share this video with your friends or families. That would be great. Thank you, guys, as always. Thanks.